Today we want to continue our discussion on transaction exposure. And last time we have been talking about the use of the forward contract, future contract, and money market hedging to deal with transaction exposure. Today we want to talk about the use of option. And so we are going to start with the slide number 12. And here, the strategy of using the option to hedge transaction exposure, and it will depend on whether the firm has foreign currency receivable or whether this firm has the foreign currency payable. For receivable, okay, like the case that we have for the Boeing when they sell the jet to British Airways, and with the receivable of the 10 million British pound in a year. In this particular situation, the Boeing ought to buy a put, buy the British pound put. By holding a long position in British pound put, the Boeing would be able to hedge away the transaction exposure associated with the British pound receivable. And in contrast, if a firm has a foreign currency payable, then that particular firm would need to hold a long position of that particular foreign currency call option. So it really depends on whether it's receivable or whether it's payable. Okay, then you decide whether you want to buy a put or whether you want to buy a call. Let's take a look at this numerical example. Next slide. And let's assume that the Boeing purchased one particular 1 year put option. Okay, and this put option has the exercise price of 1.46. And with a different level of exercise price, the prices of the put, that would be the premium, will be different. Okay. And for this particular issue, let's assume that we call the option dealer, and option dealer give us the price of the 0.02 for each British pound, and this option is going to charge 0.02 US dollar. And because, let's take a look at this one. Okay. So let's take a look at the cost of this one. Okay, so this is a unit price. Okay, for each British pound, the cost is 0.02 US dollar, and because this put option has a size of 10 million British pounds, so multiplied together, we're talking about the total cost in terms of US dollar will be $0.2 million. And this the cost today when we purchase this particular put with this particular exercise price. And this amount of cost today is equivalent to this amount of the cost in a year, because we have the interest rate of 6.1% a year. Okay, over this year with a time value of money of 6.1%. And we are talking about the cost of purchasing this put at this particular time, 1 year later, would be $0.2122 million. Okay, and it really depends on the ending price at the end of this holding horizon at this particular time. 1 year later, it would depends on what would be the spot rate. ST would be the spot rate for British pound in a year. And let's entertain with two possibilities. One is it turned out to be 1.3. The other one is turned out to be 1.6. For the 1.3 scenario, this would be the set of the computation. If it's turned out to be 1.6, if the spot rate turned out to be 1.6, the computation would be in this set of red color. This set of computation, okay, is in this current slide, and this set of computation is in the following slide. So let's take a look at the situation of 1.3. If the spot rate turn out to be 1.3 in a year, from Boeing perspective, okay, when they receive this 10 million British pound from British Airways, the logical decision would be to sell this 10 million British pound using the put option. The put option gives the Boeing the right to sell at 1.46. 1.46 is a higher price than the 1.3 spot market in a year would be able to provide. So the logical thing is to sell at 1.46 and turn out to be $14.6 million. That would be the payoff. Okay. And in terms of the profit, in terms of the net dollar proceeds, we will need to take this amount of the cost that due to the purchase of the put today, $0.2 million with the time value money consideration, the cost of this put would increase to $0.2122 million. So we will need to subtract this amount, this is the cost, away from the payout of $14.6 million. That would give us a $14.3878 million. This is a net dollar proceeds. Okay, so if the scenario is that the ending spot rate in a year is 1.3, then the use of put option will be the right thing to do. And that's the meaning of the option that gives us this right to use this put option. Okay, and another possible scenario is that if the ending spot rate turn out to be 1.6, then what would be the logical decision that would be made by the Boeing? It turns out that this set of the computation would be the logical decision. Okay, if this is 1.6, that would be better off than this 1.46 provided by the put. So we are not going to exercise this put. We are going to throw this put contract away. Simply turn the 10 million British pound based on this 1.6 exchange rate to come up with 16 million US dollar, and subtract this cost $0.2122 million cost here, and our net dollar proceed would be $15.7878 million. So it's either this net amount of proceed depends on the ending, or lower this one. And if we summarize them, if we summarize all of those possible outcomes, okay, that would go to slide number 15. Okay, if you take a look at slide number 15, and the blue banded straight line and with the label of option hedging summarize what I just illustrate to you. If the spot rate in a year is lower than the exercise price of 1.46, we are going to end up with $14.3878 million. So that would be the horizontal segment of that blue line. But if the ST, that would be the ending spot exchange rate, is higher than the exercise price of 1.46, then we want to convert those 10 million British pound on the spot rate instead of using the put option. Then we are going to have that 45-degree blue line, and that refer. So if you look at this entire shape, it's a non-linear. It's not a straight line. It's a banded straight line. So this chart to show you that option, we have this kind of non-linear payoff. And on one hand, we have hedging. That means that there is some sort of a floor some sort of a minimum amount of payment we'll be able to receive. That will be on the left hand side of this chart when the blue line is horizontal. But at the same time, we kind of preserve upside potential. That would be the 45-degree segment of the blue line. So on the downside, we have some protection. On the upside, we preserve that upside to some degree. And that is the kind of fundamental nature of option. If this kind of payoff structure is ideal from the firm's perspective, if Boeing love this kind of payoff, compared with that the break straight line, that's a forward hedging, $14.6 million, regardless what happened to ST. Regardless what ST is to the right or to the left, and the payoff is always $14.6 million with the label of forward hedge. And forward hedge, of course, we talked about that in our previous meeting. We can use the forward contract to hedge the transaction exposure. And here I kind of show you that the alternative way of the hedging is to use a put option. Okay, so next slide. And the break-even. The break-even is referred to the intersection of that break line. That would be the forward hedge. And with a blue banded line, that would be the option hedging. They intersect at the price of the 1.48. So we have ST star in the previous slide. And how can we come up with that 1.48? 1.48 is the ending spot rate that these two different method of hedging is going to give us exactly the same payoff and same net sales proceed, and that would be solving this equation that have been laid out in the second bullet point. The solution is obtained by solving the following equation, and the left hand side of the equation is $10 million times ST minus 0.2122 million. Okay, that's a net dollar proceed of using the put option. And the right hand side would be $14.6 million, and that $14.6 million is the net dollar proceed when you use a forward contract. So we solve this equation for ST, one equation, allow for one unknown, and we'll be able to solve this equation. And it turned out to be 1.48. That's a breaking even point. And next slide. And we can also use a swap. And we learn about the difference between swap and the other financial instrument in the previous topic. Swap is a recurrent periodic cash flow exchange. So the use of swap, for example, if Boeing has a long-term contract with British Airways, and talking about that each year Boeing is going to deliver one jet, and it's going to do so for a total, let's assume 5 years. Then the Boeing would be able to say, pick up a phone, talk to a city swap dealer and say that, oh, I have this $10 million British pound receivable, and I expect that the one each year and for the next 5 years, and I'm thinking about I want to engage into a swap contract. Would you please give me a quote? And this dealer is going to go back to do the homework and then come back to talk to the Boeing and say that, okay, for this $10 million, and we are going to give you a specific amount of US dollar for each of those 5 years when you receive those 10 million British pound. And if Boeing like the quote, then they can sign the contract. Then there will be for sure certain amount of US dollar down the road each for the next 5 years. So that would be the use of the swap to hedge away those foreign currency denominated receivable in this particular case, and through the use of swap, turn that into a predetermined for sure amount of US dollar that they will be able to receive. By doing so, get rid of this kind of so-called transaction exposure, this kind of foreign exchange uncertainty. Next slide. In addition, the use of the financial contract, like forward money market hedging, future option swap, and there are operational technique. And for example, the firm can shift, can share, can diversify through the use of the invoice currency. Shift, which means that when Boeing sell the jet to British Airways, instead of quoting the receivable in British pound, if Boeing has a lot of market power, they can specify this invoice in terms of US dollar and say that in a year you need to pay me, say, instead of 10 million British pound, you need to pay me, say, 15 million US dollar. And of course, by doing so, now the British Airways had transaction exposure, because that's a payable. That's a foreign currency denominated payable from British Airways perspective. Then British Airways may need to purchase a call option to hedge away. Okay, so it all depends on the dynamic and also the bargaining power between the buyer and the seller. When the seller has a higher bargaining power, they can ask the buyer to take on this transaction exposure. But most of the time, the buyer, okay, in real life, 99% of chance that the buyer tend to have more bargaining power. So usually that the seller would need to deal with this kind of transaction exposure. Okay. And the second method is to share. So instead of quoting this invoice entirely in British pound, it could be half of that would be quoted in British pound, half of that would be quoted in US dollar. So both Boeing and both British Airways has some sort of exposure to share this exposure. That's one way to do it. But it's kind of troublesome and cumbersome. And most of the firms don't do this kind of share of invoice in terms of dealing with the invoice currency. Usually they don't do that. Just have one party to take on this kind of issue and deal with that entirely, instead of both suck into this uncertainty. And even trickier and more complex arrangement is to go through the so-called diversification. So instead of quoting on just one currency or two currency, now you quoted this transaction on a basket of the currency. And ideal, I mean, conceptually, this is seem to be doable. But in real life, most of firms they don't do this kind of thing. But it's conceptually possible. Next slide. And we can also deal with this kind of hedging through the lead and lag. Lead and lag. It depends on your expectation on whether this currency, this foreign currency, is going to appreciate or depreciate. And then you may want to quote this invoice earlier or later in terms of the manipulating or manage the credit term. Okay, for example, if a currency is, you expect that to increase its value, let's assume that the British pound is going to gain some value down the road. Then if you have payable, you pay it as soon as possible. Okay, so that you don't need to pay a whole lot of in terms of your home currency. And on the other hand, if the customer in that country pay late, then as long as they are paying in that currency, it's another strategy to do with this kind of leeway kind of the choice in terms of the timing. Okay, and if a currency is depreciating, then you may want to give your incentive to customer who owes you in that currency to pay early, so that you will be able to come up with more of the value measured in your home currency. So here we're talking about that managing the time point of that payable or receivable along with your expectation of of the direction of the currency, whether it's appreciation or depreciation, that sometimes you'll be able to reduce the amount of loss associated with the currency fluctuation. Next slide. Another important concept when we talk about operational strategy is to think about the notion of the exposure netting. For many multinational corporations, they simultaneously that they have foreign currency denominated receivable. Also, they have foreign currency denominated payable. And so they will need to deal with the foreign exchange exposure associated with payable and receivable at the same time. So the amount of the hedging usually is smaller than each transaction would expect. And let's take a look at this scenario laid out in the second bullet point. Let's suppose that the Boeing had receivable of 10 million British pounds from British Airways, but at the same time the engine of the jet was supplied by Rolls-Royce, which is another British company, and let's assume that the payable of the 5 million British pounds. So you have a receivable of 10 million British pounds, and you have a payable of 5 million British pounds. So the net exposure is only 5 million British pound receivable. Okay, so the amount of a put option that you will need to purchase doesn't have to be 10 million British pound. It will be just 5 million British pound. That will be sufficient. Okay, so that's an important concept associated with the exposure netting. And another thing the manager will need to think about is that whether there is a need to hedge away this kind of transaction exposure. In theoretical finance, we have a long-standing debate about whether there's a need to do this kind of hedging, and the reason for this academic debate is that we know that a rational investor, okay, this is what you have learned in your Bsad 180 and also in your Bsad 282, when you learn about basic corporate finance and basic investing class, and you learn about that those idiosyncratic risks will not matter because they can be diversified away. Only systematic risk matter. It turns out that this kind of exposure, transaction exposure, for many firms out there, they are idiosyncratic in nature. They are not really part of systematic risk because they are idiosyncratic. So for a typical institutional investor, when they hold a well-diversified portfolio, this kind of risk, although it occurs at the firm individually, but for the entire portfolio, they will all be diversified away. So they will not really. So those institutional investors will not want those corporate managers to go through this kind of exercise to diversify those risks, because when you diversify those risks, there are transaction costs those individual firms will need to pay, and it would be better off not doing those hedging, not paying those transaction costs, and it would naturally disappear, for those institutional portfolio because they hold well-diversified portfolio. So that's kind of source of the debate. But there are other academic researchers also arguing that although from the portfolio investor perspective, whether to hedge or not to hedge doesn't matter that much. But it is quite important for individual firms, because firms need to think about their long-term sustainability. And there's a certain amount of risk that they may not want to bear. When that is the case, that there is merit for those firms that to deal with those kind of unnecessary exposure and the risk. Okay. So this is the end of this topic. And next time when we come back, we want to talk about economic exposure.